I'm going to show you how to prepare a cash flow statement using the indirect method. And the indirect method only affects the operating section of the cash flow statement, and it has us back into our cash flows from operating activities starting with net income. So I'm going to use this sheet to explain why we do what we do and why it works. So the steps down here to do the operating section starts with net income. So here is my income statement, and notice that net income has $15,000. Notice it has mostly operations in it, but a few items that weren't cash, and at least one item that doesn't have to do with daily operations of my company. So we're going to adjust for these items. First, I'm going to start with net income, which I did here. Okay, so here is your net income. Next, I'm going to add back depreciation. And let's talk about why. Depreciation expense is an expense, and it made my net income up here go down. Okay? However, it didn't have anything to do with cash. If you look at my journal entry that would have been made, you debit depreciation expense and you credit accumulated depreciation each time you have an adjustment for depreciation. And notice there is no cash coming out, so we need to add back in that. So that's what I've done right here, is I've added back my depreciation expense. It was easy for us to see depreciation expense because we do have an income statement. If you would have just been given your balance sheet, okay, you would have been able to look at your change in accumulated depreciation from 60,000 to 61,000. So that has my depreciation. However, beware that if you would have also sold a depreciable asset, you would need to take in account that before assuming that all of this was current year depreciation expense. And that's beyond the scope of this lecture, but I just wanted to put in that warning. Step 3 says to remove gains and losses. So let's talk about why. In the net income number, we have a subtraction from the loss on a sale of an investment. But an investment is a long-term asset, so it doesn't belong in our operation, so we just need to remove that. Plus, it has nothing to do with cash. Look at the journal entry that we might make from the loss of a sale of an investment. Okay, we got cash for the sale of the asset for $54,000. We had loss on the sale of these assets. So the assets had a book value of $60,000. This means we had a book loss of $6,000. So this is the amount that we're removing from our income statement because it didn't have anything to do with cash, and also it belongs under the investing section. So I'm going to remove the effect by adding it back. If it was a gain, I would remove the effect by subtracting it, which is doing the opposite of what it initially did to net income. Okay, the next one says adjust for changes in current assets. If you think about your accounting equation, assets equal liabilities plus equity. That could be owners or stockholders' equity. We could also take this even further and say net changes in assets equal net changes in liabilities plus net changes in equity. And So let's further break that down. If I wanted to know just about my net change in cash, that's the only thing I want on this side. Well, net change in liabilities and net change in equity is already on the other side. Okay, but I need to get all my other assets on the other side of the equal sign. So I would say minus, to get it to the other side, non-cash assets. Okay, in looking at that, you would see that non-cash assets have an inverse relationship. So when I start saying it's going to do the opposite, you will remember this theoretically why. Because we are trying to get to the net change in cash, so this equation helps explain why. But I'm going to give you a couple of other reasons because it works mathematically no matter which way you look at it. Okay, so let's look at that. Ordinarily, you would not see which sales were cash sales and which were credit sales. But for the purpose of demonstrating this, I have broken it down. Let's say that I have sales on account that I have not received the money for of $25,000. So I have, what that means is I've accrued sales of $25,000. I have earned them, but I have not received them yet. So here is what that journal entry would look like. Okay, but look at your income statement. Those sales, those cash sales, and then those credit sales went toward my net income. They added to my net income. But I haven't gotten the cash for those yet. So I need to reduce my net income by that amount that I have not received the cash for yet. So I'm going to take out the $25,000 of those sales that I haven't received. Okay, but remember, I told you normally we don't have this breakdown. Normally we would have to look at our change in current assets on the balance sheet. We have to look at that change from 2016 to 2017. It went up. And when current assets increase, we need to decrease them. And that's what I mean when I say we have an inverse relationship. The change in the non-cash assets, or accounts receivable in this situation, has an inverse relationship to our reconciliation.
So we're going to say accounts receivable, it went up, we go down. And again, that just makes sense because these are credit sales that we haven't gotten money for yet, and they show up over here for the change in the balance sheet account.
Liabilities have a positive account over here in the accounting equation. So when they go up, we go up. When they go down, we go down. Let's look and see why this works. Let's say all of these expenses we have paid for, utilities expense we have paid for with cash. But let's say salaries expense is an accrued expense. Remember when you learned earlier, probably in chapter 3, that our employees had worked Monday, Tuesday, Wednesday, but we don't plan on paying them until Friday. So on Wednesday, at the close of the year, we accrue salaries. Okay, accrued salaries means we go ahead and recognize the expense and we set up a liability for that. So even though my salary expense reduced my net income, I haven't paid it yet. So to get this to cash basis, I need to add it back. And again, normally you couldn't see that on the income statement. So instead, we would go and look at the balance sheet, at salaries payable. Okay. So it went from 10,000 to 25,000. So in other words, I'm holding on to some cash I haven't paid out yet. So it went up, I add back. And I would do that to every single current asset except cash. And I would go through that for every single current liability except dividends payable, which is going to be used in the financing section. Let me show you if accounts receivable, instead of having gone up, actually went down. Okay? Because current assets, remember, work the opposite. So if accounts receivable would have went down, I would have increased it over here. It would have said decrease in accounts receivable, and I would have increased my number. Here's why. I had extra cash coming in from a prior period that wasn't showing up in my sales from a different period. But it did affect my cash in a positive way. So accounts receivable going down makes my reconciliation and net income go up. Let's talk about if salaries payable would have gone a different direction. Here it went up, and when a liability goes up, we go up. But had it gone down, had your total liabilities gone down, that means I would have paid out more than I show as an expense on my net income. Okay? Because I'm paying out from a previous period. So if I went down, this means I need to reduce this because more cash went out than what I showed inside my net income for the period. And remember, this is only for current assets except cash and current liabilities except dividends payable.